Hi, I'm Jerry Fishers, the Loan Man. We're here with Susie Lawler, who has over 20 years' experience as a Notary Republic and presently works for several highly respected banks and escrow companies in assisting homeowners and future homeowners in signing their loan documents. So Susie, tell me a little bit about your background, how you got started in this.
Well, thanks, Jerry, for having me. And
My pleasure.
I've been in the industry. I've worked for a savings and loan for 21 years and escrow and title for the last 11. I've been a notary for almost 20 years, and I have a lot of experience in both lending, escrow, and legal documents.
So why is it really important that borrowers understand what they're signing?
For several reasons. The clients want to feel good that they made the right choice about their future, their most important investment, which is their home.
Mm-hmm.
And it further instills good relationships that this may be a client in the future or a client for life.
So what exactly is a HUD-1?
In plain English, the HUD-1 is the estimated closing statement. It tells the borrower exactly what they're paying for in their credits and debits, their fees and charges. It basically breaks down what you're borrowing, what we're paying off in terms of an old loan.
What you're paying the lender.
Correct. And then the new lender's fees and charges, the escrow and title charges, and any miscellaneous fees that, or charges, or credits, for that example, will show up on the HUD-1 or estimated closing statement.
And you have prepaid interest as well.
Yes, it also does have the prepaid interest on the closing of the old loan and of the new loan up front.
And most people don't understand when it comes to interest that they pay interest in the arrears.
Correct.
So if you're signing loan docs, let's say, for example, you're signing loan docs June 15th, you're going to have your first payment on August 1st, is that right?
Correct.
And that'll be for the month of July. 30 days full pay, and then you'll be bringing interest payments. You'll bring in an interest amount, a dollar amount interest based on a daily interest amount.
Basically, you're correct in that there is prepaid interest on the old loan because your interest is paid in arrears. So using your example, June 15th, and I don't suggest using June 15th, I like June 1st myself. But let's say, for example,
Why?
The reason being is that if you're paying off a loan June 1st, then your next payment will be July
1st.
Correct.
Right, right.
Because you're always paying 1 month in
And
arrears.
this way you don't have to bring in a whole month's worth of
payments that will be,
yeah.
that could affect what you're bringing into escrow or what
Especially
if you're
if you don't
getting
have the
cash
money.
back.
Yeah, on a refinance or
And
something like
most
that.
people refinancing today, they are very cost conscious about what they're bringing into escrow.
I think refinancing today is more difficult than it used to be. For one reason, people don't have the equity they used to have. So if they are getting a rate and term loan, I think lenders are very specific about cash out. So people a lot of times are floored by how much money they have to bring in to close just a refi, when typically lenders used to give them a lot more slack.
Well, there used to be more credits, though I have to say that all our fees and charges today are very are in line. They're they're reasonable. I think lenders, escrow, title, we're all conscientious of the fact that the borrowers are looking for a bottom line number that works within their budget.
And what is the promissory note?
The promissory note is your contract with the bank and the borrower. It clearly spells out what you are borrowing, the dollar amount, at the interest rate, the number of years you're borrowing, and any additional terms and conditions such as late fees. The promissory note is the most important document the client is signing. It is his contract with the lender as to how much he is borrowing, the interest rate that he's borrowing that money at, the number of years, he is going to borrow that money.
Mm-hmm.
And the terms and conditions, anything special such as an adjustable rate, or if it's a fixed rate, which most of the loans today
Maybe
are
for 5 or
fixed rate.
7 years, something happens after 5 and 7 years, so they have to understand.
Correct.
Okay, so that's very important.
It's their contract with the lender.
Mm-hmm. But on the promissory note itself, and I've seen them, there's so much there, and it's just too bad, but it has to be there, that a borrower's not really going to read probably till he gets home. A lot of just boilerplate legalese that they have to unfortunately read, but I think the key components of that loan, the rate, the term of the loan, like you said, any kind of variations, those are very important, and typically the lender will have gone over that with them, so that you really shouldn't have to explain too much, right?
Well, Jerry, some lenders do cover that.
Mm-hmm.
A lot don't.
Mm-hmm.
I make sure every client understands the document they're signing.
Mm-hmm.
I cover every step of the promissory note,
Mm-hmm.
from start to where they sign. Most of them are very comfortable at the point of signing that document. They fully understand their contract, their terms, their conditions, and the amount they're borrowing. Basically, there's no surprise by the time they're done.
Especially in today's world, because I think the government has clamped down on lenders just kind of blowing stuff by consumers, and they have, with good faith estimates and truth in lending documents, and everybody having to sign everything and knowing everything. I think that's kind of a good thing. So that makes it less surprising for somebody when they show up and see that, my God, I'm not getting this rate. I'm paying a lot more than I thought I'd be paying. That used to happen, but probably not so much now. It never happened with my clients, by the way. I have to say that. But go ahead.
Clients won't sign.
Mm-hmm.
If
Yes.
there was any, if there is an issue with the promissory note,
They don't
they
sign.
will not sign,
Yes.
and rightfully so.
Absolutely. And what is the deed of trust?
The deed of trust is the security agreement of the lender. It records against your home the dollar amount that you're borrowing and spells out the terms when this note is due and payable. If you plan to pay off this loan with no problems, the deed of trust will mean nothing to you because it is the bank's security agreement. When they lend you X amount of dollars, this is their safety net that they're going to get back the number of dollars they lent you.
Because it's a secured loan,
Correct.
and they're attaching the security, which is the house.
Correct. The bank is going to be your silent partner in your home.
Mm-hmm.
Once you
Nice.
pay,
Yeah.
once you pay back your lender, they will reconvey and take themselves off title.
Mm-hmm.
This also will be the security document if you
Yes.
don't pay.
If you don't pay, that's what
Correct.
they have. And then,
It's a guarantee that they're going to get paid back.
regrettably, I think I was reading in the newspaper today that I think the banks foreclosed on 95,000 homes this month, 1 million this year. And I just have to say that's just a very sad situation, and I don't know how relevant that is to what we're doing, but it really is kind of sad because the documents that we create, we have to create them to protect the bank, and then when the bank isn't paid, they're able to foreclose on a property. It's very regrettable, and 95,000, that's just
I saw the
horrible.
news today. It's a staggering amount, and unfortunately, economic situation
Mhm.
that we're in today
Mm-hmm.
necessitates that.
Yes.
Some of it is self-imposed, but I believe there's a lot that isn't.
Yes.
And I feel very sad that you have to give up your most treasured possession,
sad.
which is your home, for most of us.
It is sad because, like with me, some of the people that have lost their homes that I have lent money to as a mortgage loan officer, whether I was at Bank of America or Washington Mutual, these people did have good jobs. I mean, they qualified, full documentation, full everything. Whether they picked the adjustable rate, which, by the way, ironically, those are at 2.25% today. So people that still are people that have kept those loans have been saved by those loans to some degree because the rates and the payments are so low. But that aside, I think the many people who did get loans, who were well qualified because of the economy, have suffered and have unfortunately lost their homes, not because they misrepresented anything. It's because they just lost their jobs and they couldn't make the payments. And they were qualified then. They're not qualified now. And the banks, some of the banks are working with these people, some of them are not. It's tough.
It's a very tough situation out there today. I wish I had an easy answer for all of this.
There are no easy answers.
And there isn't. So.
And when you sign loan documents today with people, I guess I know just because of the new rules that have been imposed on lenders, the borrower walking into your office certainly has to know a lot more than they did a year or two ago, because first, the loans are easier. They're fixed and they're fully amortized for the most part. And the lenders just pretty much bombard them with all kinds of information that they have to acknowledge.
And let's give some credit to the borrowers themselves. Most of the borrowers are much more knowledgeable than they were several decades ago. Today, they're very savvy. They know how to negotiate interest rates. They know what they're looking for.
And also, fixed rate loans are easy to shop for the most part. Unfortunately, the rates change 3 times a day. That makes it difficult. But once they decide on a lender and they move forward, yeah, they pretty much know what they're doing. They know what the fees are. They know everything.
They're very savvy, and they're negotiating those too as well.
They are.
So
they are. They really, really are.
You're not talking rookies in this business anymore.
Yes,
they're
right.
savvy. They're intelligent, and they're knowledgeable, and that's where our job becomes a little bit easier, because
I can see that.
Because we are talking to people who are familiar with the process, and they're experienced. Most have already refinanced or purchased before, and if they haven't, they have somebody with them generally that takes them through that process. And we're fortunate that we do have such a wide range of knowledge that's available to both us as lenders, as the notary, and to the borrowers.
And I think another factor is that you're not seeing many bad loans come across your desk these days, because there used to be so many subprime loans that were kind of masked as good loans, and then somebody would look at the paperwork and say, oh my God, I didn't know the rate would go from 4% to 12%. You don't see that anymore. So I think that's a good thing too. I think the loans that are put forth today, for the most part, almost without exception, are good loans at good competitive rates.
No, most of the clients are very happy with what they're signing with me.
Okay, very good. Anyway, I think we've covered a lot of ground. I hope you've enjoyed this interview with Susie Lawler. I do appreciate her stopping by and sharing these insights with us. So anyway, thanks for joining us, and have a nice day.